Good evening. People are still joining. So let me first wish all of you a happy new year. So I'm meeting for the first time in the new year. Right. Am I audible?
Yes, sir.
Okay, great. Right. So although the new year is new, we have to continue some of the old things. Right. We started this course last year, so we continue. So we have few more topics to go anyway. The last topic we were discussing was the investment risk. Let me share the screen. Right. So this is what we started discussing. And just to recap what we discussed, we completed only a few slides, but just to recap what we discussed the other day for the benefit of all, maybe due to the newer celebration, some of you may have forgotten this. Let me quickly recap what we have learned. Right. We first define what is an investment, and then we identified what is investment risk. Investment is a decision to forego, because you have to forego your consumption if you want to go for an investment. But the advantage is when you forego it and invest it, you can get something more in future. That means you are going to generate more revenue, right? Increase your wealth over a period when you have an investment. Then we discussed what the investment risk is about. It's the risk of not being able to materialize what you intend materializing, right? Or the required return. You have a required return in mind when you invest. The risk of not being able to get or realize that required return is what we call the investment risk. Right. Basic concepts we discussed: inflation, nominal return, real returns. We discussed the connection among these concepts, right? So nominal return is what is published or what is available, what is presented to the investor, or we also call it the coupon return, whatever, right? And then inflation is a general increase in the price levels, and the real return is when you eliminate the inflation impact from the nominal return, you get the real return. Right? That is the purchasing power of your income. That's what the real return is. Then we discuss the connection among these things, right? It's not addition or subtraction. It is 1 plus real return into 1 plus inflation rate equals 1 plus nominal rate. And we did some examples also, and we got to know how to do this. Then we also learned something called total return. There are certain instruments, when you invest in those instruments, it generates multiple income options, opportunities. So if you take shares, you get dividends, and if you sell the share at a higher price than what you purchase, that's capital gain. If you take a bond or a bill, you have the same thing. On top of your, especially for a bond, on top of your coupon interest or the interest that is mentioned, there's a price at which you purchase the bond, and then when you sell the bond at a particular price in the secondary market, you may get a higher receipt or higher amount. So that difference is another gain. So you have a capital gain plus interest or dividend. So when you take the total return you can earn for a given investment is called the total return. Then we also learn holding period return. When you do not, so in other words, it is a return you earn over a period within which you keep the instrument with you. If you keep the instrument till the maturity, the total return that you earn from that instrument goes to you. That is your holding period return because you hold it for the entire tenure. But there can be a situation where you do not keep the instrument over the total tenure of that instrument. Instead, you might sell it in the middle. If it's a 5-year bond, you might acquire it and you sell it after 2 years. At the same time, you might purchase a bond with a maturity of, let's say, 5 years, and then you purchase it in the 3rd year and you keep it till the maturity afterwards. So the total return you're going to earn over that period from 3rd year to 5th year, that is the period you hold that instrument, and that return is called holding period return. So that return, the value HPR is different to your total yield or your coupon because you only take the yield for that particular period. So we did these examples. I will not take time on those. Then we discussed this concept, compound interest, simple interest, and then we talk about the time value of money. So time value, we discussed, it is not necessarily the inflation, it is the ability to earn during the period. If you get money today, you can grow it to a higher value, and that ability will have a time value for your money. And then we discussed how you connect the future value and present value. So future value is equal to the present value into the factor. That factor, this is compounding factor. That is 1 plus R is your interest, N is the period. Then we can rearrange this. If you want to find the present value, the same thing in a different way. You divide the future value by the factor. This is called the discounting factor in that case because you take the present value, because finding future value is called compounding. Coming to the present value is called discounting. So the same way, so you get the present value, right? And there's another part we did not discuss, that is called the annuity. Annuity has multiple cash flow situation, but it has a slightly different formula. But here we already talk about a single cash flow situation. You invest and have a maturity period, and then you look at the future value, or other way around. Then we discuss something called EIR. EIR, right? Effective interest rate. We also call it effective interest rate is something that we mostly know. And then what we do is we sometimes, if you look at the published documents, or because there's a rule I told you the other day, so regulation that you need to publish the effective rate when you publish financial instruments or advertise them. So the term that most of the people use in that case is AER. AER, annual effective rate, right? Same thing. Effective interest rate and annual effective rate, these are the same things, although you see different terms. So what we do here is, when we have interest payments for a given instrument more than once a year, when you have more than once a year interest payment, or we call it compounding, your effective return is greater than the nominal return. So you can say, I pay you 10% annually, then you get a 10% return at the end of the year. When they say 10% biannual, your actual return is more than 10%, because for the second half, you have the ability to earn interest on interest. So therefore, the effective rate is higher. So you can mathematically calculate the rate with some numbers if you want, or you can straight away use this formula to get the effective rate without any values. You can simply use the rates and the given details. R stand for the nominal rate, M stand for the compounding frequency. That means how many times per year. If it is biannual, M is 2. If it's quarterly, M is 4. If it's monthly, M is 12. If it is daily, M is 365. So whatever the frequency in the respective instrument, you can use here. And then we have to get the power M also. The same thing, what you put inside the bracket, you have to put outside the bracket as well. Then from the overall answer, you deduct 1. So that will give you the effective rate. And we also did some examples, so I will not take time to discuss or illustrate it now. I think that's where we stopped the other day. If any one of you didn't participate for the previous session or have forgotten what we discussed, now I think you must have got a refresher. Before I move forward to the next slide, which is what we are going to discuss from today, is there any question or clarification on what we discussed already? It need not be what I have shown here. If you have a practical question or issue on the concepts that we discussed, still I am open to respond. Any questions? Right, no questions. Right, no questions. Let's move. So now we're going to discuss main investment risk. That means when you talk about this investment risk, it has components, right? Subcategories for us to discuss. So let us first see the list of those risks. We have currency risk, interest rate risk, issuer risk, equity risk, commodity risk, property risk, liquidity risk. That's what we are going to discuss. Right. Let's start with currency risk. Right? Currency risk. Now, this risk arises when you deal with different currencies, right? If you deal with the same currency, you won't have the currency risk issue. When you deal with multiple currencies, you are exposed to currency risk. Sometimes you convert your money into a different currency and invest. Let's say you have rupees, you go and invest in dollars, and then you have to realize that in dollars and then convert into rupees. Or you go and invest in another country. It can be pounds or euros, anything, right? Then, because there's exchange involved, right? Conversion of currency is involved. You are exposed to the fluctuation of currency rate or exchange rate, right? So the example is a UK investor buys shares in a US company, which just most of its trading in the US. So this company is a UK company, but invests in US. Naturally, you have to convert your pounds into dollars and invest in the US market. Now, when the price of the dollar fluctuates on the US stock market, you have one problem. That is, when the price fluctuates, we discussed, can you remember the market risk? Anything to do with the price is market risk. The movement in the price, right? The share price in the market, if you invest, you are exposed to the risk of share price being volatile. It can go up and down. So that can have a risk. So that risk is the market risk, right? Because it's a market thing, and when the price moves up and down, even if you are in the US and you invest in dollars, you have the same risk, right? It doesn't matter whether you come from UK or any other country, the price fluctuation will be there anyway. So that component of risk is called the market risk because that is due to the price movement. Then you have the currency risk in this case because there is a exchange rate movement up and down. When the dollar rate goes up and down against pound, you are exposed to a risk, right? So if you want, you can look at an example. Let's see. You can look at, you invest 100 pounds, right? This is 100 pounds. And at that time, the rate is 1 pound equals $1.5. That means this will be $150. Right? Now, let's say you in this market, you keep this investment and sell at a later date. By the time you sell it, the share price has come down to 140. Right? So in that case, what happens? You are losing $10 in value. That is your market risk. Right? Here to here, what you lose is market risk. Then this $140, now you need to bring back to UK. Let's say at that time, the exchange rate is 1 pound equals $1.2. That means dollar has got appreciated. Dollar has got appreciated. Right? So how much pound you get? Can someone tell me? How much pounds you get? Any idea? Okay. $117.5. Is that right? How do you get it? How do you get the pound figure? We divide $140, divide that by 1 point, how much? 2. So what do you get? Is the given figure correct? Yes. We get 116.67, right? It's 116.6, let's say. So what happens here? Because the dollar has appreciated, right? Dollar has appreciated, you get 116.6. What if the exchange rate remain the same? What if the exchange rate remain the same? If the exchange rate didn't change, how much you would have got? Yes, 93.3. Now understand this, right? So at the same exchange rate, right? At the same exchange rate at 150, right? But how much is the difference here? $10, right? At this rate, how much is that in pounds? In pounds, how much is that? That is 10 divided by 1.5. That is 6.67, right? So let me use a different color. I'm trying to show you something interesting. Right? This is, sorry. Right. This is pounds. This is pounds. Right? This is pound. And this is all pound. This is all pound. Right? This side, other side, all dollars. Now I have invested 100 pounds. And at that time, the exchange rate was 1.5. So $150 I get. Then in that market, the share price have crashed. Right? Share price crashed. Therefore, I lost in dollar terms $10. In pound terms, I lost 6.67 in value. Right? But there is a appreciation in dollars. When you appreciate dollars, what happens? You get more pounds for the dollars than earlier. Earlier, right? For you need 100. So one pound 1.5. Now one pound only 1.2, right? So with the dollars you have, you can get more pounds. That is why you get 116.6. That means pound terms, you have a gain of 16.6 from the original investment. You follow? From the original investment, you get a gain of 16.6. You invest at 100, you gain 16.6. But the 16.6 is, right, there are two sides to this. You lost 6.67. This is a loss due to market risk, right? Then 23.3 is your gain, total gain due to the exchange rate, right? In total. So in this case, you have materialized your market risk, but on the currency side, you don't have a risk, you have a gain. So what if the situation is different, right? Let's say this is what happened to Sri Lanka as well. I'll explain that later in terms of how our exchange rate works, right? In rupee versus dollar. Instead of 1.2, by the time you come here, let's say the dollar depreciates and pound appreciates. Then you need more dollars to get the pounds. Let's say this is 1.5, let's say 1.7, right? If it is 1.7, 1.7 is to 1. That means this 140 should be divided by 1.7. You get 82.3. You see, then you have a market risk. You lost 6.67 there. Then you have the currency risk. As a result, you get less pounds into your hand. So in that case, you have the net effect here, as you can see. From the 100, this is the case. Right? So you should be able to distinguish between the two, market risk and currency risk, because this entire thing is not. So this entire, say for example, this 100 to 116, right? If someone says this 16.6 is the currency risk, that is wrong. Risk or gain, that is wrong. Right? You have to take off the market risk impact, and the balance is the currency risk. In this case, there's no risk, there's a gain. Second case, you have a risk because there's part due to the market risk, the balance is due to the exchange. Right? In the dollar rupee case also like that, right? When the exchange rate goes up, you have an advantage on the export side because less dollars, more rupees. But at the same time, import side, you have a problem because to get less dollars, you need more rupees. Your import side, you need more rupees. When the exchange rate goes down, then again, less dollar, goes down, you get less rupees for dollars. But we are gaining on the import side because we can get more dollars for the rupees that we have. So it works either way. So that part is called the currency risk. But the reason why I want to explain this way is for you to understand that when you invest in another country, you should not take the total gain or loss. from your initial investment to the final realization as currency risk, because currency risk involves only with regard to the exchange part. The price fluctuation related component is market risk, right? Okay, let's move. Then you have interest rate risk. So then again, the interest rate risk is when you invest in an instrument that pays you an interest, and if the interest rate moves in a disadvantageous manner, right? You borrow at fixed. This is what happens in the current context to some of your borrowings, right? So the bank has given you a fixed rate, right? And then when the market moves down, you're still paying a fixed rate. So you're losing, right? Because when you are paying a fixed rate, when the market goes down, you are losing, because you are paying a higher rate than the market. And if you have invested at a particular rate, let's say fixed on a fixed deposit, you have invested at 10%, and the market rate goes up, then again you are losing, because you don't get that advantage because you have fixed your rate. So this example is here: an investor borrows at a fixed rate of interest over 3 years to finance an investment. During this period, interest rate moves down to 2%, but the loan is still locked into a rate of 5. That's what I explained the first example I gave you, right? Then the other side is the deposit rate. I think that is understood. Then we have issuer risk, right? Issuer risk. The risk that the bond issuer, whether a government or a corporate, gets into financial difficulties and cannot keep up the interest payment. What do you mean by that? Remember, we discussed when you talk about the counterparty risk and the credit risk, the counterparty can be a issuer sometimes. Right? Issuer means the party who issues the instrument. So once you issue the instrument, it can go to another party through the secondary market, right? So let's say bank X can issue a bond, then ultimately it's the responsibility of bank X to honor when the bond matures, or even the interest or the coupon payment has to come from that day. But whoever is purchasing or investing in that bond, that investor might sell it at a later date to another party before maturity. Then the holder of that bond has got the bond from another party or a broker or an intermediary, not from the issuer. So when the issuer doesn't honor the responsibilities, that is paying the coupon or settling the debt, then whoever is holding the instrument is at a risk. So that is very important. So I think we sometimes fail to realize this component when we deal in the secondary market. When you purchase, let's say you get a company X issuing bonds, and you get the bond from a primary dealer or someone in the middle, right? Finance company or investment company or maybe a bank, right? They acquire this and then they resell in the secondary market. So you think I bought it from X bank, right? I bought it from this bank. Then you keep your trust and wait. But actually, your bond issuer is not the bank. Your bond issuer is someone else out there. You also need to do a due diligence and keep following up what's going on with that party as well. Because halfway down the line, the issuer can go bankrupt. You're holding a bond. issuer may not honor it, right? So therefore, without limiting your interaction to the intermediary or the party from whom you buy this, you have to also look at the issuer. Then we have equity risk. Equity risk is for shares, right? I told you earlier, shares, we have two types of returns or income. One is the dividend income, the other one is the capital gain. Then we have a risk on both income as well as capital, right? Because there are situations, even in the current context, we see in some organizations, right? The share market, you go and purchase the shares, and then if the company is not profitable enough, they may not declare dividends. Even if they don't run to losses, they can still have profits. But if the company doesn't declare dividends, the shareholders won't get it. Therefore, it is not only the company's ability to generate profits, sorry, but also the history and the appetite to declare dividends. Sometimes even when you look at declaring dividends, some organizations declare a reasonable percentage of their profit as dividend, but some organization might declare a very minimal, a small fraction of profits as dividends. Right? Therefore, you run into risk, not necessarily because the company doesn't have profit. If the company doesn't declare, you have the risk. Then the capital gain part, it's mostly to do with the price fall, right? Price fall. So in this case, the share market is sensitive to various factors. Technically, in an efficient market, the share prices need to be adjusted in line with the fluctuation in the value of the company, because share price reflect the intrinsic value of a company. But in an undeveloped or underdeveloped, or we call it semi-efficient or inefficient stock market, what happens is these share prices can be influenced by various other forces as well, irrespective of the company. That is what happened to even Sri Lankan market. So you see the fluctuation in the share prices without a major movement in the value of a company. The share prices tend to fluctuate because the market is sensitive to other factors like political movements, right? Some major events, and also markets like Sri Lanka can be manipulated, right? There can be market players, certain players, influencers, manipulators. They can artificially adjust the share prices. They can artificially move the share market in different directions. So as a result, the prices can move. So that is one of the reasons why in the markets like Sri Lankan market, you cannot go and make investments using fundamental analysis. So fundamental analysis is where you do all this scientific theoretical analysis, but the predictions you come up with, those analysis might not support you to judge the real movement in the market, because the market is influenced by other factors. So the investors are taking all these risks, right? So if you are investing in share market, you need to know all these factors and how it is affecting your returns. So then it's a choice you have to make. Are you holding this investment expecting the dividend income, or you want to look at capital gain, or both, right? So it depends on your strategy, how you want to deal with your, right? Next. Now you can see in the shares, you can see further risk factors stemming from what I discussed, but some specifics for knowledge purpose, right? So there you have liquidity risk. Can anyone remember liquidity risk? What we discussed on liquidity risk. This is not cash. We discussed previously. We sometimes say the share market is liquid or not liquid. What does that mean? That is availability of sufficient volume of transactions, right? You have sufficient suppliers and demands, right? Supply and demand should be there for market to operate. But if you have less activity, right, low interest from the demand side or low interest on the supply side, the market doesn't function. So the liquidity risk is that, right? Not having sufficient volume of transactions to continue the market. So that can take the prices at different levels, right? It will upset the equilibrium. So you can't sell. Then you have growth risk. What do you mean by growth risk? That is, when you buy shares, I told you, there are two types of returns we are looking at. One is the capital appreciation. That means you're expecting the share price to move, grow, right? And the prices move up. When this happens, you get a gain. But the problem is when the expected growth doesn't happen. As I told you earlier, this growth in the share market is influenced by the company performance. If the company performs well, then there's an impact on the share price. And despite the company performance, when there are environmental factors and other influences, the share prices can stay at whatever the prices, maybe even go down. Then you have volatility risk. Right? I think we discussed this term earlier as well. Volatility is fluctuation. So when the share prices fluctuates up and down, so that creates doubt about your ability to get a reasonable return. And at the same time, when there's fluctuation, it also makes your life difficult in predicting the movements. It's difficult to predict which way the share price will go because it fluctuates. Then you have the strategic risk of the issuing institutions. What do you mean by that? That is, whatever the company issues the shares can be under influence due to various things. So probably some industries go through the environmental effects or cyclical effects, right? For example, in the current context, when there is an economic downturn, the people's choices change, right? The demand therefore change for certain goods and services. So if there are companies who are supplying some of those goods where the people have now stopped purchasing or reduced their consumption, then those companies have low performance, poor performance, and that can affect the performance of P&L. As a result, it will affect the share price. And also, another problem that we see even in the current context in the Sri Lankan situation, the management or talent, when the top talent leaves the organization, when they have human capital issues, that can affect the performance of the company, and then in turn will affect the share price. Sometimes, there are examples. If you go to the share market, Sri Lanka, and in the global market as well, when when particular figures in the market, right, reputed figures in the market, personalities join companies, their share prices go up, right? When popular, competent people join the companies, their share prices go up because the market is sensitive to those factors. That gives a positive signal. At the same time, when the competent people of organization leaves the company, that also sends the signal to the market, and therefore the prices can come down, right? Then you also can have situations when the company has financial issues, your financial landscape is not in the right shape. Although you may not see a drop in the profitability in the current year, whatever the published information, let's say you have achieved increase in profits over the past few years, so it's a growth. But there can be other indicators in the balance sheet, and if you look at in the P&L, that might give an impression or a signal to the reader what can happen in future, whether the company can maintain the profitability as it is, or whether there can be an impact on those. So that can be predicted by people when you look at the parameters. Therefore, those kind of information can have an impact on the organization's share price. So these strategic issues, this is called strategic risk. The strategic risk of the issuing company can have an impact on the gain or the return one is expecting to get from a particular share, right? So that I have already addressed. Then we have commodity risk. Commodity risk. Right. Now, commodity, there is a definition. You can't consider an item as commodity if it doesn't meet this criteria. It doesn't identify anything as commodity. It only recognizes certain components, certain selected items as commodity as long as it meets this criteria. But is that the product should be identical, right, across the market when you talk about it. You can't have various versions, right? There's an identical commodity. For example, let's say gold, right? You know, gold, you say 22 carat, 24 carat, whatever, you can define it, grade it, and it's a commodity market. Then you have rice, wheat, sugar, oil, right? Those are all commodities. right? Coffee. You can add to the list, right? These are the common things. Wheat. Now, the problem with commodities is the prices can fluctuate, uh, probably due to market forces, and that also, especially if you look at agricultural products and all, it's highly sensitive to the climate, right? And there can be impacts there as well. Therefore, you can have volatility in the prices. Now, these price movements, if there are adverse movements, you have a risk. Then you have property risk. So another area people will invest when they have money is property. So what is a property? That's also important to know. So this purpose, what do you mean by a property? Asset class, right? When you say property, you have a class of that item. So then you have unique distinguishing features for a given set of assets, and then you can have different types of assets. Right? What are the risks? You have the location. Location can create risk. Right? Let's say you have a house. Let's say, right? If there's a house, and if the house is located in a coastal area near the sea, right, very close to the sea, almost on the beach, you have a risk of that property. So the location matters. Then the use, how you use, right, depends on the item or you have. It can create the credit quality of the tenants. That is also risk. What do you mean by tenants? The party, whoever is occupying that, right? Then if those people do not have the capability, then the property owner will not get the return. The length, the lease. If it's a lease, you look at the length, right? So what is that? When the risk, when the tenure is more, the risk is high. Then we have market risk. Market risk, as we discussed in the previous chapter, is when we have an impact on the pricing, overall pricing of the value. When there's a change in the interest rate, the property market has an impact. Why? When the interest rate goes up, what happens to the value? The value comes down. And in the high interest market, property market prices are low. The value comes down. When the interest rate is low, property prices go up. Then performance of the sectors, right? Now there is big agitation among developers in the current context, right? That is property developers, because they say it's very difficult for them to be in the construction industry as all the materials are out, very expensive, and can't find clients who can afford it, and the developers can't maintain their cost structures with the prices. So as a result, the sector as a whole is suffering. Right? Then when there is an impact on the sector, as a player of the sector, then the particular organization can have an impact. Then if you own a property and looking at earning rental income, so that again can have fluctuations, right? So it's a prospects for rental income growth, right? If there is a ability or opportunity for a property to earn income, the value of that property can go up, because that ability to earn income from the property will add more value to the property. That's the idea, right? If you can grow the rental income, then the property value can go up, because that supports the valuation. Right. That's about property risk. Then liquidity risk. Right. I discussed earlier. So this discussion here we talk about cash. Now look at this. When you have, let's say, collateral or assets pledged to the bank, right? That is the second part. So when you have property, you can sell it and get cash. That's part. Then you can use it as a collateral. Then what you are going to do with that is you are trying to manage the credit risk by providing a collateral. Right? Now, the liquidity risk in terms of investment is when you want to convert your asset into cash, then you have a collateral, or when you have a property, you want to convert that into cash to get the money into your hand, right? Then how likely that you are going to do that? Right? So how, if the organization is able to convert that asset into cash without a problem, then this won't happen. This risk won't happen. But in reality, this risk is there. It depends on how the organization is managing it, or the investor is managing it. Right. Those are the different types of risk coming under this. Now, when we talk about investment risk can be discussed at two levels. Right? That is individual asset level. The other one is as a post-pool. Pool of investments. Collection. So how you deal with each of this? So mostly when you talk about risk, I told you, so the actual result is different to what is expected. So that move is generally considered as risk. So it's a volatility. Now, how you get the risk as a tangible measure? So we discussed the previous chapters, some of these techniques, statistical techniques to calculate some parameters. So when you take standard deviation, Standard deviation is a measure of dispersion, right? Deviation from the central point, right? Now, this volatility can be measured through that. Mathematically, you can do that. So you can take the returns, take the given examples or the situations where the returns have fluctuated, and then identify the movement. And that movement can be then used in the formula to get what the standard deviation is. So if the standard deviation is low, risk is low. If it's high, risk is high. That's the mathematical interpretation of that answer. So when you want to calculate this, remember we are talking about this risk, right? Of a given portfolio or given asset at present, and risk is always future, right? We talk about risk for the future. In the future, what will happen or where the risk is. Now, when we try to get the information, you may not have the future information. Therefore, what you do is you get the historical information, get the data, analyze it, and then you define what the future is going to be. Then, based on what your current understanding, you can alter some of those justification and then see what would be the future risk is going to be for the volatility. There you can take some market pulse, some regulators' opinion, experts' opinions, or how people think about these things, where the market is heading. You can get all these insights, and then we decide on the volatility factor. Now look at this example. Suppose that an investment has an average annual return of 9% and standard deviation of 4. Right? So what does it mean? Go back to the bell curve. The bell curve, what did we learn? Right? Let me pull it. Right? Average return is 9%. That is the mean. Standard deviation is 4. So one standard deviation up and down or left or right is what? 9% plus 4, that is 13. 9% minus 4, that is 5. So the range is 5 to 13. So what is the coverage here? 68%. That is almost 2/3. Right? 2/3 of the data is within this range. So you can say there is a chance of 2/3 or 68% chance that the annual return will be between 5 and 13. So if I add another standard deviation, that is 13 plus 4, that is 17. 5 minus 4, that is 1. So what is this? There is a 95% chance, right? 95% chance that the return will be between 1% and 17%. right? That's how you indicate. Right, someone is asking, can you repeat? What do you want me to repeat? Which one? You can elaborate, remark. You can mention what you want me to repeat, I can do that. Right, I think you understood it now, right? Whoever others, right? You look at this coverage, and then based on that, you will. Okay. The 68, 95% of the story, we discussed in the previous chapter under normal distribution, if you can remember, in the normal curve, let me see if I can get it. Normal curve was there in the market risk, right? We discussed on the market risk. Normal curve. Do you remember this? Right. And the normal distribution in a given set of data. So the midpoint is the mean value, right? Mean value. Then you keep on adding 1 sigma, 2 sigma, 3 sigma, standard deviation, right? One this way, this way. So plus and minus 1 range, right? Between plus and minus 1 sigma from the mean, this area, 68% of the data is within that area. So we can say there's a 68% chance that the results will be between these two levels. So if the stand is in this case, example, 9% is the mean, then standard deviation is the 4. So 9 plus 4 is 1 standard deviation, that is 13. 9 minus 4, 5, right? Then if you add another sigma, that is 9 plus 4, 13, 13 plus 4, 17, and 5 minus 4, that is 1. So between 1 to 17, you have 95%. So you can say there's a 95% chance that the results will be between 1 to 17. Right? I think that's clear now. Right. So there's a chance of 1/3, right? So then 2/3 is inside the 68%, and the balance 1/3 is outside these two, right? So there's a 1/3 chance of either it being lower than 5% or being more than 13%. So that range. Right. So the volatility risk of the volatility of a share fund can be compared with the benchmark. That means when you want to evaluate this, you can compare with the benchmark in the market, right? To see whether the volatility of this share is reasonable or it's more or less, right? How acceptable? Then you use a benchmark. Benchmark is something that is outside this share, and as a standard, you refer. So this volatility index you can close, for example, so blue chip shares in Sri Lanka also we have, right? Milanka index or something like that. And then we have all share price index, right? And in the LSE, London Stock Exchange, there is something called FTSE 100 index, right? FTSE 100 index is the popular one. So there you take the top companies there, and that index shows the overall performance of those shares in the market. And then the movement of the index is about the overall movement of share prices up and down. So you can take a particular share of a company and then see the fluctuation of that share against the movement of FTSE index, right? If your shares movement is more, or volatility is more than the FTSE, that means your share has a higher volatility risk, right? Higher risk than the FTSE index. If it is other way around, you are the safer investment because your movement is lesser than the FTSE 100 movement, right? That is one. Or you can have a fund. There are different funds operated by mutual funds, right? There are funds operated by the uh, various institutions, right? Financial institutions. So in Sri Lanka also we have things like NDB, right? Then Namal, right? There are various funds like that. So they go and have the portfolio, and some of these portfolios have their own names for the funds. Those funds can be used as benchmark because that fund is a reflection of a portfolio, and then the movement of that value of that fund gives you an idea about the movement of the overall portfolio that belongs to that fund. And then you can look at your investment or instrument and see how far your instrument is moving against that, and then get an idea about the volatility or the risk. Right. So with that, I think we've discussed little high-end stuff today in certain areas, but logically these are not difficult areas if you get it right. Let's take a break now. So we'll get back in 20 minutes and we'll continue with the next. Right? It's almost 8:20, so 8:30, maybe around 8:45, 50. We'll get back. Sorry, I've been talking without the mic. Sorry. Uh, there's a question. There's a question in the chat box. I was responding to that. The question is, do you think we can get through the exam only by listening to classroom lectures several times? So my point is, yes, I'm teaching from the textbook. I cover the lesson, but I don't go to each and every aspect or the nitty-gritties. I only take the essence of the chapter and then teach. So even the areas that I talk about in the class, certain people might get it, certain people might not get it the same way because your learning style might be different, right? Sometimes when you read the book, you understand it better than when I explain it, or maybe you can connect it and improve your understanding. So therefore, I recommend, while I say that I cover the syllabus in full, I recommend that you read the book and get better understanding because it helps you at the exam. Anyway, we do these things in detail. We do a deep dive at the revision stage because some of these concepts you can understand better when we do the revision. So there I am doing with papers or the questions. You'll understand. I think I've told you before as well. You get multiple choice questions and you get 4 answers. It's very difficult to figure out the answer out of the 4 answers given because even if you filter, you will still get at least 2 good answers. So sometimes the difference between the two might be a word, right? Or something, a small item or small phrase, a keyword that distinguishes the answer from the rest. Therefore, it's very important to understand this concept well. And especially this is application exam, right? At the exam, most of these questions you'll hear from the application point of view. So therefore, while I would say what you learned in the class is adequate, I recommend you read the book and understand it better so that you can be better prepared for the exam. So that's my recommendation. Uh, anyway, it's up to you, right? You can listen to the lesson several times and get it if you don't get it in the first time. But reading the book might help you. Okay? Right. Let me move. Right. Benchmark. Actually, it's a technical term you all know. When you say benchmark, we generally use the term benchmark when we want to compare or evaluate something against a standard or something in the best in class or kind of thing. So here in this topic, the benchmark is a standard. Right? When you want to compare the performance, you look at something I told you earlier, FTSE 100 shares is a benchmark because that index is a benchmark to measure the performance of shares or any other portfolio. Right? Here you can see when you what do you mean by a fund? Fund is a collection of investment, right? Fund, you have a fund for a specific purpose or with some specific criteria. Let's say you want to get a return, a constant return, then you go and invest in bonds. Because bonds have a given interest coupon or whatever, then you go and invest in several bonds. You have a pool of investments and then you get a constant return. So likewise, there are different funds. So when you have a fund, you can benchmark it to a peer group, right? That means you get a fund and then you have other best-in-class funds similar to what you have, and then you can compare yourself against that and see how best you are doing your fund. Then you can have market index, right? That's what I told you earlier, FTSE 100. It's an index. It calculates the overall performance and then come to a specific index that gives you a feeling about the performance. For certain type of funds, you have certain standards. That means you can define the standard where you want to operate. This is generally included in the investment mandate, where you define what the standard is, what the criteria is. Because then, especially for government and various other highly scrutinized organizations, they specifically give a framework within which you have to operate. Then you have no flexibility. You have to work within those framework or the standards. Then the beta factor. What's the beta factor? It's an indication of risk again. What do you do with this? Here what you do is you will compare the volatility of an investment related to the market or the benchmark. So there what you do is you look at the fluctuation in the market portfolio and then see against the market portfolio how far the selected instrument or share is fluctuating, right? So this beta can be plus or minus, right? It can be any number. It's just a fraction. Say, for example, let's say if beta is 1, whatever the calculated beta figure is 1, that means the movement of the performance or the price of the selected share is in line with the market or the benchmark. That means when the benchmark increases by 10%, your share price might also increase by 10%, right? That's the idea. Market or the benchmark is a good reference to measure the performance of your share because it moves in the same level at the same volatility. Then if the beta factor is greater than 1, that means, let's say the beta factor is 1.5, that means when the market portfolio moves by 10%, the selected instruments performance or the return moves by 15%. That means 1.5 times the market. Right? It's when you say it's a positive thing, that means the same direction. Right? Up or down, right? Then if the beta factor is less than 1, if it is less than 1, what happens? Let's say the beta factor is 0.5. If the market portfolio moves up by 10%, your instrument will move up only by 5%. That is 0.5. So that's how you use the beta factor. You take the market portfolio movement, then you use the beta factor, multiply that movement by the beta factor to get the movement of the instrument, right? So that's an indication parameter use to measure the risk. Sorry. Then we have alpha, Sharpe ratio, and information ratio. These are 3 different ratios we use to measure the performance. Alpha is a indicator that see what's the extent to which your portfolio is outperforming the benchmark, right? So that means you look at if your portfolio is doing well, then you see how far it exceeds the benchmark. So there is a formula to get that. Then the Sharpe ratio, the excess return of a portfolio over the risk-free interest rate. Risk-free interest rate is generally we take the treasury bill, treasury bonds, or government that we consider as a risk-free. Now, how much excess return is made by the portfolio over and above the risk-free rate, right? And that will give us how far you have compensated for the risk, right? Here is the example. The return on portfolio, risk-free return. So that will give you the excess return over and above the risk-free return. Then you divide it by the standard deviation. That means per unit of risk, how much excess return is there. That's what it says. That gives you the level to which your risk is compensated by the excess return. Then the information ratio, there's something called tracking error, right? So then you look at the excess return to the tracking error, right? How much excess return is achieved to the tracking error. The tracking error means standard deviation, not the standalone standard deviation. We calculate the standard deviation against the benchmark. You have a benchmark, right? You take the benchmark, then you take the excess return of the portfolio against the benchmark, right? So benchmark has a, let's say 10%, this portfolio is 15%, so excess return is 5%. Then you take the standard deviation of the benchmark, standard deviation of the portfolio, what is the excess there? Then the incremental return is divided by incremental risk, right? So this is how you get, right? Mean of excess return. You get the excess return and then standard deviation of excess return of the benchmark. You don't need to worry about this is because you don't get to calculate these ratios because when I see the papers in the questions, I did not see any requirement to calculate these ratios. Instead, the questions always had been to define what each of these ratios mean, right? What they measure. So it's you need to know the meaning of them. Right. So when you look at this, we discussed the standard investment instruments up to now. And there are, if you look at the typical items that we find in the investment arena, that's the instruments, shares, debentures, bonds, kind of things. Then there are uh, other items, right? They're not very liquid, they're not very much in the market. So they are in occasional situations, small markets, and liquidity is relatively low, right? So how do we deal with it? So we have venture capital, private equity, and property. Let's look at them. Venture capital. Venture capital. Venture capital. So it's a typical organization, right? It's a typical organization. It's a private equity capital. Because the difference between a normal organization and a business and a venture capital is generally they have a higher potential of generating exponential growth, right? That means these businesses, they do not maintain, they do not continue forever. They have a bright idea, they invest in that, develop it up to a certain level, and then scale it up, exit. So there are people who are in this business, right? You set up a business, develop up to a certain level, and then exit, right? If that exit can be in different forms, you can go to the stock market and exit, or you can get in a private placement. There are different ways of exiting. So this you can invest in a private equity venture capital in business. So that the problem is this kind of businesses, they have a greater potential. They have a greater potential, uh, but at the same time, there is great risk as well, right? So not everyone will invest in that kind of places. You have high risk and you have high return as well. So technically, these venture capitals offer higher. So venture capital have some features. against a standard investment. So tax advantage. Now again, this tax advantage is subject to the legislation of the respective country, right? Because I don't think in Sri Lankan context we have specific tax provisions for venture capitals, but certain countries they have specific tax reliefs, tax advantages, exemptions available for venture capital. Then, because the regulator also is aware that this kind of businesses will not have lucrative returns at the early stages, and you need to encourage the people to stay in the course, and then at a later stage when the businesses start making excess returns, that is when you need to start taxing them more, give them a hard time, because then they are capable of paying the tax. So likewise, there are incentives, right? Then the potential for higher returns. As I told you, venture capital will start with a bright idea and then it can generate higher return at some point. Then there's lack of correlation with more standard investment. So what happens when you don't have a correlation? Correlation is what? A connection, right? That means there is similar movement, right? If a standard deviation moves in a particular way, this will also move in the same way, right? If there is a risk coming from the external market, let's say the political risk, right? If the political risk affects the standard investment in a particular way, this will also have the same impact if they are correlated. But when they are not correlated, the factors that affects the standard investment will not affect the venture capital investment. They're at a different level. So that's a advantage, because then this you can get rid of the challenges or the risk of a standard investment by moving to a venture capital, because it has a different flavor, but at a risk at a different level. So those are the features that you can see in a venture capital. Then we have private equity. Private equity is where you go and invest your money in businesses without going through stock exchange, right? Their shares are not traded in the stock market or anything. You go and invest privately in those companies, and you cannot simply exit in those investment, because in the stock market, if it's a listed company, you can exit anytime you want by selling your shares in the market. There's open market, there are people to buy your shares, you can sell it. But private equity, you go and directly deal with the company and you pump money into the company and you become a shareholder. And unless that company gets into the stock market, you can't sell your shares, you're stuck. But there privately you can exchange, but not as easy as a stock exchange. Because the parties need to be comfortable with the party, whoever is coming after that. And there are certain processes that you need to follow when you want to exit in that kind of a setup. Right. Now here, when you say invest in private equity, you can either invest in the initial stages for the seed capital, or you can go and acquire another company by investing in that. Now, again, these private equity investments are also not correlated to the standard investments like equity, typically in equity, the share market or bonds or anything, because they are in a very controlled and very closed setup, because it's not in the public domain. But you have a risk, as I told you, if the company fails, if the company goes bankrupt, you lose your investment. Then property. Property is very straightforward as asset class, right? It can be a building or land, right? Class of assets. So the term property is used for long term. So it gives you long term benefits all the time. Now, for a typical investor in traditional investment, a property can be a good option to diversify. Sometimes people come and ask, okay, I generally invest in the stock market, right? So do I have a diversification option? Yes, one option is to move out from the stock market. While you continue in the stock market, you can go and acquire property or land or a building. So that's a good alternative to diversify your assets. But the problem in that is sometimes certain markets can be can have prolonged downturn. That means the market prices can stay longer, right, at a low level. So sometimes it can happen in the days to come now when the people lack uh, capacity or the ability to acquire or afford properties. They might not go and acquire properties because of the prices or lack of purchasing power. Then you can have supply, but when the demand drops, what happens is the prices come down. Therefore, the property market can crash or collapse. Right. Then what happens is you will have to hold your investment in property for a longer period until it corrects itself. So therefore, you can get stuck with your cash flow unless you are prepared to take that and invest and then hold. Right? There are situations where people acquire properties with borrowed funds. So that's a tricky area because if you don't get your property off the ground, if you don't get a buyer for that, then you have a problem with your borrowing. You keep serving the borrowing, and then it might end up being financially losses as well. And there's this concept called responsible investments. This is uh, an emerging topic in the global context. There's big attention towards this ESG, environmental, social, and governance. How responsible the organizations are in dealing with those areas, right? How careful you are with the environment when you do whatever you do. How far you take the social element in your business decisions, and then the governance, that is controls, internal aspects, proper procedures, right, structures, authorities, all those things. So let's say the environmental concerns, we know the natural resources are limited and there is a threat to the forest cover, and there's something called global warming. There are a lot of other things being talked about the environment. So how far you have accommodated that? The social, the human rights, the needy people, right, underprivileged, right? In the current context, this is very much important. Then comes the governance, right? How you run your organization. So these things are looked at. Now, this is an important area. This thing not only add values to organization, it also increases the market value or credibility, right? I used to learn something long ago, right? But still, I think it's valid. There's a fund called CalPERS, right? California Public Employees Retirement Scheme. Now you can go and search CalPERS, right, in the internet. It's a kind of a retirement scheme or fund, right? Like the pension fund that we have. They have a very strong governance mechanism within this and an investment mandate. As part of their investment management strategies, they go and invest in other companies, right? They invest in the shares. Now, they have a mandate. I haven't read the recent one, but I'm talking about my learning long ago when I was doing my MBA. They have this practice. When they invest in companies, they study the corporate governance structure of that company. And they have a standard. If the governance standard of those companies are not up to the minimum expected level by CalPERS, they will not go and invest. Either the companies should have the minimum governance standards, or they must be prepared to go through a transformation with the support of CalPERS to bring that organization to the expected level of governance. So that is the investment policy. Now, the beauty of that is, as a result of this policy, It's a known thing in the market that CalPERS is having such a strong and robust investment mandate and how they deal with the companies when they invest. In the sense, the market has a idea when CalPERS go anywhere, they make sure that the governance of that company is improved. Because of that reason, when CalPERS goes and invest in companies, the share prices of those acquiree companies goes up, right? The share prices go up because the market knows when CalPERS touches it, that means the company is in good hands. The company's governance will improve, as a result, performance will improve. So to that level, this responsible investment aspect is being used by organization. So it's very important that organizations understand it's not just the investment as a financial value that they need to look at, and how you create long-term value to the organization by focusing on these areas. So these things can add long-term value to the organization, their reputation, and the public acceptance. Then correlation of performance between asset classes. I explain you what correlation is, right? I explain how it operates, the correlation, the meaning of it. Now, the reason why we need to know this is, as I told you, let's say asset classes, you have share portfolio, you have debentures, you have property, likewise you have. So sometimes there could be a correlation between these two assets, right? Classes. So let's say, for example, when the share market activity is declining, the property market activity can go up. People might move from the share market to the property market. There's a negative correlation between the two. When the share market goes down, property market goes up. Let's say something like that. But these correlations won't remain as it is forever, because due to various reasons, they change over time, right? So what happens is, when asset classes correlate differently with each other, and when these correlations change time to time, you need to also look at how you reallocate your funds, right? Or your assets into different buckets, right? That is diversification. Diversification of, because when you say diversification, in its sense, it's basically talking about the basic diversification of getting into more investment portfolios. But asset allocation is the overall strategic perspective of an organization, where your total portfolio of funds, how are you going to put into different areas depending on those correlations? How much of my money is going to the property area? How much is going to the uh, stock market, right? Likewise, you decide. Before deciding which stock to pick, a decision must be first have been made on which asset mix to choose. That's why I told you, right? First, you have to decide how much of your overall funds would be allocated for the stock market, investing in shares. Let's say out of your total funds, 40% will be allocated for the stocks. Then out of that allocation, you then decide, okay, within the stocks, what particular shares am I going to pick? That's the idea. Tracking error I explained earlier, right? You compare your standard deviation return related to the benchmark, right? So that in the previous ratios, the tracking error was explained. Investment mandate is not a difficult thing. This is where the organization, when you have investment, you have to clearly explain these things, because this mandate is the one read by the potential investors, and they decide whether to come on board with these funds or not. right? You can see it has several features, the why you do this, what is the aim of this, right? Because each investment can have aims. You want to build a fund secure portfolio, you want to generate dividend income, or you want to appreciate your value faster. You can have a lot of different aims and see whether the appetite of the investor is similar to this, and then you can come and take part. So look, likewise, you can see the points. I will not go one by one. So all these things need to be documented before you float an investment fund, so that the investors will have a look at it and they decide whether to come on board or not. Now, when you talk about the investment portfolio risk, so investment individually, you have a risk, you can generate a portfolio and mitigate it. When you have a portfolio, how you mitigate the risk of portfolio? So there are terms we need to know: systematic and non-systematic risk. That means systematic risk is undiversifiable. That means that risk is across the board in the system. Therefore, system-wide risk you cannot diversify by having a portfolio. It's like the political risk. When you have the political risk, it's a systematic risk, because whatever the industry you are going to get into, that risk is there. Therefore, by getting into different industries, you can't avoid the political risk. That is systematic risk. That is called undiversifiable risk. The non-systematic risk is the risk that is not limited to the system. That means when you change the background or the area, you can manage the risk. Say, for example, you have a risk in the construction industry, you go and invest in the banking industry, then you are mitigating the risk of construction industry. So by diversifying, you can eliminate the risk. So the non-systematic risk can be diversified. Optimization. I explained you what optimization the other day, right? I told you mean variance optimization, right? That's where we talk about when you select a portfolio, you take the portfolio with items where you get the highest possible return for a given risk and the lowest possible risk for a given return. So you create the portfolio, this mean variance efficiency. That's where the optimization comes. But diversification is mere spreading your portfolio into other areas. But there's one condition to have diversification intact, that is, you must diversify into other areas which are not 100% positively correlated. Because if it is 100% positively correlated, then there's no impact of diversification because the risk is not mitigated. So your correlation has to be less than 100%, less than 100%, in the sense 1, right? It has to be less than 1, and -1 is ideal. Portfolio hedging, we know what hedging is, right? Creating an independent position to manage the risk of an existing position. So we do it at the portfolio level, that is called portfolio hedging. Short selling. This is not legal in the Sri Lankan context. Short selling is, let's say, for example, you have shares, let's say share market, John Keel's share prices now currently going at 250. Now you have a feeling that the share prices will go down, right? Maybe up to 200. That's your assessment, right? So when the share prices are likely to go down, if you buy now, you can't sell it at a higher price. So short selling is you sell before you buy, right? That means you can, without having a position, I don't have John Keel shares, but I offer a sale to another guy. I'll sell you John Keel shares at 250, right? But your delivery happens in 1 week's time, let's say, right? I will deliver it in 1 week's time. I sell it to you now. Then you sell it and get the deal done, and then you buy it later, right? That is called short selling. But in Sri Lankan market, it's not applicable. So in developed market, this short selling is a strategy used. Risk transfer is you give it to someone else. That's why you do insurance and various other techniques for other parties to take care of the risk. Yeah, I have already explained all these things, right? Right. I've just gave you a high level thing. Then finally, monitoring, managing, and in reporting, right? Monitoring, managing, and reporting. That is not a very difficult area. It's an administrative aspect. So where which say you need a robust risk management process in the organization in order to make sure that you balance between your risk and return based on the investment or risk appetite of the organization. So you need to look at the benefits, right? You get benefits when you have a proper monitoring and management reporting process. You can review with peers. When you do this, you can do a peer review with other fund managers in the same. So with inside the organization, you have other fund managers. You compare with them how you do it. Right? You can do this. Then you can do a risk review with independent. Right? Those who are not involved in the fund management part, you can have independent risk people. They come and do this. Then you look at the compliance with the mandate, where you have the investment mandate, and then you look at your investment performance and you compare and see how far you have done it. Right? Then performance attribution reporting. That is, you go piecemeal, take each area of your performance and then break it and report in different forms. That will give an idea about the performance. Right? So again, this is how what I explain is explained. Right. I think with that we conclude the. We don't do questions today. With that we conclude the lesson. Any questions, clarification before I wind up? Right. If you don't have any further questions, that's it for today. I'll see you next week with a new topic. Good night.